In this week's market update, central banks sow confusion with the hint of higher rates coming sooner, the scores on the doors at 2017's halfway mark, and the new politics. Is this the end of austerity? Once again, central banks are the main story for investors. This time, however, the narrative is anything but clear. The past week gave investors plenty of food for thought as the Bank of England and the European Central Bank in particular struggled to present a coherent picture of where they're heading with interest rates. In what looked like a coordinated bid to bring forward expectations of rate rises in the Eurozone and in Britain, Mark Carney and Mario Draghi both provided broad hints that monetary tightening was on its way at a get-together of central bankers in the Portuguese hill resort of Sintra near Lisbon. In the case of the UK Central Bank, this was an unexpected change of tack for Governor Mark Carney, who only 8 days before had seemed to go out of his way to make it clear that a 5-3 split in the Bank of England's Monetary Policy Committee did not mean that a rate hike was imminent. He made it clear that his preference was for continued caution. So, to say in Portugal that he now believes some removal of monetary stimulus is likely to become necessary left investors bemused. The currency market took him at his word and pushed sterling higher in anticipation of higher interest rates making the pound a more attractive investment. It now stands at around $1.30, the top end of the range it's traded in over the past 9 months or so. Others were less convinced, believing that on closer analysis his message was not so very different from that given in his Mansion House speech. Essentially, both were variants on the wait-and-see theme. Mr. Carney still sees big threats to the UK economy from Brexit, and he wants to make sure that any weakness in consumer sentiment and confidence is being offset by other parts of the economy, such as business investment, before he tightens policy any further. Perhaps more important for global markets is what Mario Draghi had to say about the re-emergence of reflation and signs of economic recovery in the Eurozone. This matters because fear of deflation has been the driving force of European monetary policy in the years since the financial crisis, and in particular since the sovereign debt crisis that it morphed into 5 years ago. A return to growth would be a significant watershed for the region. Now, if Draghi's words had been the end of it, this hint of an end to the ECB's negative interest rates and bond buying programme would have been an unwelcome but not exactly unexpected reminder that easy money must come to an end. In that regard, it would have been similar to Ben Bernanke's reminder in 2013 of the same inevitable tapering of quantitative easing. But, as in the UK, there was also confusion as far as European policy is concerned. Just a day after Mr. Draghi spoke in Portugal, officials at the ECB told journalists that the market reaction, which had pushed the euro to its highest level against the dollar this year, had been misjudged. The ECB is clearly fearful of a rerun of the 2013 taper tantrum, when investors worried that rising rates would choke off the economic and stock market recovery. So, the bottom line is that no one is very sure what the outlook for interest rates is on either side of the English Channel. But what is clear is that at some point Europe will catch up with the US as the world returns to some semblance of normality. That has a few implications. It probably means that European currencies, particularly the euro, will strengthen against the dollar. It's probably bad news for the government bond prices and by extension to corporate bonds, which are priced relative to the yields on government paper. Certainly, the bond market felt the full force of reheated taper tantrum concerns, with the yield on Germany's 10-year Bund up 21 basis points or 0.2% last week, while the equivalent 10-year gilt in the UK saw its yield rise 22 basis points. Even on the other side of the Atlantic, the 10-year US Treasury yielded 14 basis points more at the end of the week than it did at the beginning. But a big question mark remains over whether the European economies are yet in a fit state to handle higher rates. Just as the same doubts hang over the US, where many investors worry that the Fed's planned tightening path is unrealistic. Whatever happens, central banks are going to continue to be on investors' radars for quite some time to come. Now, nerves are clearly in evidence across financial markets as the year reaches its halfway mark. This has been particularly noticeable in the part of the market that's driven performance during those first 6 months, technology. The Nasdaq index, in which many of America's tech stocks reside, closed last week 1.8% lower, its biggest weekly loss all year. Stock markets were down across the board, with the S&P 500 0.5% lower on the week, the FTSE 100 off 1.5%, and European stocks more than 2% down. In Japan, the weekly loss was the same as in the US, 0.5%. The bright spot during the week was the energy sector, which has struggled recently on the back of the weakening oil price, but which perked up in line with the cost of crude. Brent ended the week 5% higher at $47.80, as the weaker dollar made the cost of oil easier to bear for non-US buyers. Oil tends to move in the opposite direction to the US currency. For the first 6 months of the year as a whole, there's been a marked divergence in the performance of developed and of emerging markets. The developed world has lost steam, especially during the second quarter, as hopes for a Trump trade have faded at the same time as interest rate expectations have tightened. Meanwhile, emerging markets have enjoyed a decent rally as the valuation comparison has favoured markets in Asia. Between January and June, the FTSE 100 rose just 2%. Japan and Europe were 4% higher, and the US, fueled by technology, rose 8%. But emerging markets were up 17%. They did more than twice as well, with India remaining in favour and China benefiting from the forthcoming admission of A shares to MSCI's global indices. Now, looking into the second half year, the ability of companies to continue growing their earnings is likely to be the key driver of markets in the developed world, especially in the US, where valuations look increasingly stretched. Fortunately, profits do seem to be on an upwards trajectory. 9 out of 11 major sectors in the S&P 500 index are expected to report second quarter earnings higher than a year ago, even if the 7% rate of growth is running at only half the 14% notched up in the first quarter. On the political front at home, Brexit continues to cast a long shadow. The latest evidence that uncertainty about Britain's place within Europe is affecting business decisions came this week with news that investment in Britain's motor industry fell to just 300 million or so in the first half of 2017. That was after a 30% fall in 2016 compared with 2015. At the current rate of progress, investment in the motor industry this year would be just a quarter of the 2015 level. Now, the car industry is one of the most interconnected of all European businesses, with complex, just-in-time supply lines that stand to be compromised by any additional red tape if Britain does indeed leave the single market and the customs union. Meanwhile, the fallout from the general election continues, with the UK cabinet now apparently divided on the austerity programme that has dominated British politics since 2010. With ministers now lining up to question curbs such as the 1% cap on public sector pay awards, pressure is mounting on Chancellor Philip Hammond to ease up on the tax and spending squeeze. Assuming that he sticks with his stated intention of balancing the books by 2025, the obvious question is, where will he find the money? With further tax hikes the most likely solution.